Good morning. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland's UM Ventures. I'd like to extend a warm welcome to all of you who joined us today for our next installment of Startup Fundamentals Workshop Series. And this topic is an important topic on taxation, tax issues for tech startups. Both live webinar audience and those watching the recorded version on our YouTube channel, StartupUMD, like to again extend a warm welcome to all of you. This workshop series is offered by UM Ventures in collaboration with MTech at the Clark School of Engineering and Dingman Center for Entrepreneurship at the Smith School of Business. I'm very pleased to introduce today's speaker, Samuel Handwerger. He's a CPA and holds MS in accounting. He is a full-time lecturer at the Smith School of Business here at the University of Maryland. He's also a TERP. He's a UMD undergraduate accounting alumnus. He also holds a master's degree in taxation from the University of Baltimore. And Sam, I'm going to let you talk more about your background because you tell that story much more interesting than I can.
Okay.
Thank you for sharing your time with us and your expertise in discussing this important topic.
It's my pleasure to be here and to help budding entrepreneurs. One of the great experiences that you, an entrepreneur, can give a CPA like myself is to let us be your advisor, be your mentor, both in accounting, taxation, and growth of business, and then to see you take off with that and grow your business. I've had a couple of experiences in my career where small startup came our way. We got together, we were the accountants and the tax preparers and planners, and the businesses blossomed to beyond our wildest belief. Maybe not beyond the wildest belief of the entrepreneur, because all of you are eternal optimists. And so I give you credit for where you're holding in life and the dreams that you have. Hopefully they'll come true. I think we have a rather a manageable crowd at the moment, Ala, so I'll leave it to you. I'll let the participants know they could put questions in the chat box, and Ala, you feel free to interrupt me. We can take the questions as we go along.
So I'm gonna go ahead and turn off my mic and my camera, so it's gonna be all you. And to those in the room, please feel free to submit your questions. You can submit them anonymously if you wish to do so, or not, or you can also post them in chat. And we already have a raised hand.
So why don't we check with that and get the yes.
Go ahead, Peter.
Maybe it was a
maybe it was a mistake. All right, yeah. So why don't we go ahead and start the presentation, and I'm going to turn my mic and camera off, but I'll be monitoring the camera.
Okay, so you should see my screen. I'll just let me know if it looks like, all right, so we're going to get started. Today's topics are tax credits and other incentives for small businesses and all sizes of businesses, actually, and particularly interesting for startups because it could be a source of capital or favorable loans, as we'll see. Most of these incentives that allow you to get capital investors or to get favorable loans are involved in what's called tax credits. So to start off, just to make you a little dangerous with tax law, I'm going to give you a basic primer of how tax law works. You have to report your income, obviously, because it is called an income tax. You report your income at some number, let's give that an X. You're allowed deductions, which are your expenses. We went over that last week. You're allowed to reduce your income by whatever legitimate deductions you have, and then you come up with a taxable income amount. It's based on that taxable income amount that you pay tax at a certain rate, and the rates depend on what kind of business entity you are. Now, after you take the rate times the taxable income, so we'll go taxable income times rate, you'll come up with the tax. That makes sense. So now you have the actual tax you have to pay. Where credits come in are right down here. Credits actually reduce the tax. They don't reduce the taxable income here. No, that's not what they do. But they reduce the tax such that if you have a $1 tax credit And well, let's do it this way. Suppose you have $100 of taxable tax to pay. That would be here. Suppose this number came out to $100 and you have $90 of tax credit because you're investing in something that the government wants to give tax credits for, like you're buying an electric car and there's tax credits for that. Well, now all of a sudden, if you get $90 of tax credits, you only have to pay $10 of tax. Again, the example was you had $100 of tax, your tax credits came out to $90 based on the incentive that the government has set up, you only owe $10. It's worth more than a deduction. The deduction is only worth what the tax rate is. Tax rates are something below 40%. So the tax credit has more value than a tax deduction, and thus allowing for the tax credits is a huge incentive for businesses to follow as a way of, okay, let's go there, let's do that. The government wants us to do this, and that's exactly the point. So let's go through what these are. We're going to do some that are geared for startup businesses, some that are geared for all kinds of businesses, but particularly of note for startups. The first one we're going to do is what's known as the Opportunity Zone Tax Credit. It is based on a particular geographic locations that exist throughout the country. We'll see maps in a little bit, but in these particular zones, you have the ability to get this tax credit. What the government realized, just to give you a little background, when it comes to tax law, just a brief little background here, when it comes to tax law or perhaps any law, it really helps to understand what the reason for the law was. In this case, the government perceives that there's trillions of dollars of investment gains that haven't been sold. We only tax when an investment gain is sold. So there's trillions of dollars the government thinks that have not been sold, and those trillions of dollars would yield taxable income to the government if it was sold, but people don't want to pay the tax. So in order to incentivize people to help the economy, what they've set up is this concept of, okay, so don't pay the tax on the gain, sell your investments, reinvest it in an opportunity zone, a geographic location that can use the money, an impoverished area of America. And by reinvesting that and not paying tax, so now you can sell your investment that's appreciated, your Apple stock, your Amazon stock, et cetera, and then not have to pay tax, at least right away, by investing it in these opportunity zones. So a lot of startups have gotten their capital by being located in the opportunity zone. That's going to be the first thing you need to do. You're going to need to locate there. We're going to see a few other rules. And what happens if you're in that zone, you attract people who are selling their investments but don't want to pay the tax today. So let's just take a quick dive into the program. As you can see, it directs investments, the sales of investments into qualifying geographic areas known as the qualified opportunity zone. Taxpayers that invest the capital gains into these O funds, we'll call them that, receive a number of tax benefits. And these are some of the tax benefits they get. Now, this is not for you if you're the entrepreneur, but this is what your investor could be looking at. They sell their gain in Apple stock as an example. They invest with you. Now what they have is a situation where they don't have to pay tax on that gain until December 31, 2026, or until the time they sell, whichever comes first. The deferral is a very powerful tax planning technique. By not paying tax today and investing in your business, let's say, they get to watch your investment grow, and that growth means more money to them. And they were able to invest more with you because they didn't have to pay the tax on the sale of their investment that they're using to invest in you. So one more time, they deferred the tax on the sale of the investment that they are going to use to invest in you. Now they have more money to invest in you, more money to make more money through the growth of your business. So they get a deferral. That's number one. Now, they also get, in 5 years, 10% of the gain is eliminated if they hold on to the investment in your opportunity zone business. If they hold on for 5 years, they get to receive a 10% reduction of the gain and a 5% reduction for 7 years if they add another 2 years to the 10 years. Now, if you do the math, you might see, well, gee, this is 2022. I have to sell it by 2026. Where's the 5 years? There's no 5 years in there. So how do I get any reduction? And you're right. So right now, Congress has in front of it considerations to extend this from 26 to 28. If they do that, then the opportunity zone is really alive and well and can be looked upon by you as, again, an important source of investment. It's interesting to note, before I go on, that despite the fact that we see that unless Congress extends it to 2028, some of the incentives are gone, the opportunity zone has taken off in 2022 in a way that nobody would have predicted. It's continuing to carry steam. And the reason for it is because if they invest in your business, even if they don't get that 5-year reduction of gain by 10% or a 7-year reduction of gain by 15%, even if they don't get that, when they invest with you, whatever appreciation your business gives them in their investment, if they hold it for at least 10 years, they're exempt from paying tax. It's zero on the appreciation. So there's been, I suppose the way to maybe look at it is, and I don't know all the economics behind it, but there's perhaps been in the beginning of 2022 up until now, a theory that, hey, our starting businesses today are making good businesses. So that's, let's invest. We have a chance to have some appreciation, and therefore, looks like we're gonna have. Could you try again? Let me turn that off. There we go. It looks like we're gonna have a chance to have appreciation on our investment. If we hold it for 10 years, zero tax. So that keeps the opportunity zone tax credit rolling along. This is an example of an opportunity zone map. I've got Maryland in a second. Just a couple other things about it. And that is that if you're going to do this and you're going to attract investors with this tax benefit, you have to have at least 50% of your income derived in the opportunity zone. You have to have at least 90% of your capital assets that drive your business located in the opportunity zone. So you're really going to be doing business in the opportunity zone, but there's lots of leeway with this. So you could have an internet business and still derive a lot of your income outside of the opportunity zone. But if you play by the rules and you have most of your employees in the opportunity zone, or you have most of your subcontractors there and a couple other exceptions, you can open up a business in the opportunity zone, do business nationwide, worldwide if you wish, and still qualify for these credits for your investors. These are a couple of the, quote, sin businesses that you can't be in. You can see what they are, and you can imagine why they're called the sin businesses. So here, there are no credits for these, but I don't believe too many of us in the audience have this in mind as our entrepreneurship. And if you do, it's okay. It's just not eligible for this credit. You and your investors do not have to be located in the opportunity zone itself. It's your business that counts. It's the bulk of your employees, the bulk of your subcontractors, suppliers, things like that. This is the Maryland map of the opportunity zone, just to give you a quick bird's eye view. The green obviously represents the areas where the opportunity zones are found. The state of Maryland knows very well where they are. That's how you would contact Maryland's opportunity zone people, and they'll tell you what's available, what locations are available. All right, so that's a taste of what a tax credit might be to incentivize investors to invest in your business. Here's another one called the New Markets Tax Credit. This one, as it's going to turn out, is mostly been used for real property, real estate investments, but many other types of businesses make use of it. Let's see how this works. It's not a credit to you per se, but it's a credit to your potential lenders. And because your lenders are going to get a potential credit, then they can lend to you at more favorable terms, better interest rates, less strings attached. So it's an incentive for investment in low-income communities, as opposed to the opportunity zone, which were depressed, impoverished areas. There's some overlap with the New Markets Tax Credit, perhaps, but the opportunity zones were were drawn on the map by the various states themselves. They determine what areas will be the opportunity zones. So there could be areas not on that Maryland map that qualify for the new markets tax credit. And basically how it works is there's this CDFI fund. This fund has the credits to give out. They're given an allotment of credits by the federal government. They control the credits and they determine who's going to get it. And the new market tax credit is generated when there's a qualified equity investment, meaning there's money put in by investors into something called a CDE, qualified community development entity. So investors invest in these qualified community development entities, then they go back to the CDFI and they ask for tax credits to be allocated to them. So the investors investing in this get tax credits for putting money into it. And then what does the CDE do? The CDE uses the funds to make loans to qualified active low-income community businesses. So you may approach banks, you may, if you're in a low-income community business, and they may direct you to qualified development entities, equity funds for the loans, particularly if you're a startup and you're maybe on a little bit of a risky side compared to the bank's general concepts of what they would like to lend to. All right. The credit ranges from 5 or 6% per year, depending on how it works, up to 39%. Again, the credit is not to you, the credit is to the investors, and they're going to be able to give you a better loan terms because they're getting these tax credits. There are obviously people who are in an upper tax bracket and they're trying to reduce their tax. Here's an example. I'll let you take a 15-second perusal of what's on this list. These are some of the projects that have been given loans by the new markets tax credit, the funds involved in there. Up at the top, it says retail and mixed use. And it does include retail shops, but it includes the real estate involved. Okay, now we turn to something really, really important. Research and development costs. So we're going to take a real big, now we have to listen to this. These are going to be known as R&D costs, research and development. Many of the startups in this audience are going to be incurring research and development costs as they get started. Let's say you're doing engineering work, you're trying to develop something. Let's say you're developing a software product, an application. That's going to qualify most likely for research and development costs and the tax benefits that go along with it, which are many. There have been some changes in 2022. We're going to see what those are. Let's first find out what are research and development expenses. What are they? They are incurred when a business is trying to create a product or improve a product that already exists. And this is going to include even internal systems, internal products, internal software. Doesn't have to be something for sale. Includes internal, we'll say, products and systems. So it's a real important, wide open, very broadly interpreted type of cost that you can incur and qualify for research and development costs and the tax benefits that go along with it. The costs include trying to obtain necessary information to eliminate uncertainty, and that's the whole key. This is what drives whether it's going to be research and development, is are you incurring these costs to study? It doesn't have to be a scientific study, but to study, to test, to look for a way to do something, whether it's internally or for products or services that you're going to sell. Are you looking for something that will make something better than it's been before? And there's a degree of uncertainty in your testing and your design work and your whatever it is that it costs you to develop it. And that's again why it's called research and development, emphasis on the word development. As long as there's some kind of element of uncertainty as to whether it will work. Now, and let's take that not at face value. Let's take it as it's been defined by the Internal Revenue Service and the tax courts. The uncertainty just has to be, it's not quite clear that this will be the best way to go. You may say, well, I know this will work, but is it the most cost-effective way? Is it the best way? Is it the fastest? Will there be some other methods that we would say, okay, this will work better? And as long as there's this degree of uncertainty, it doesn't have to be a large degree, but a degree of uncertainty as to whether this is the best way to design something internally or for external sale, or then your costs to improve or create that product or design qualify for the research and development costs. And this, again, just reiterating the fact that it doesn't have to be something you're going to sell. It could be something you'll use in your business, maybe a new way of producing, a new way of doing the, let's say it's a service business, a new way of delivering the service by a different type of software or a different type of application to help deliver it. Developing that is what will qualify for research and development. As you can imagine, this slide makes sense. Once the uncertainty ends and the new and improved product has been developed, then R&D expenses also end. Whatever you do from that point on, advertising it, promoting it, packaging it, that's not a research and development cost. That's something different. That's towards the selling of the product, basically. Here's some examples of the products that can be included. And as you can see, hopefully you can see that some of these are definitely not products and processes that are going to be used outside of your business. Many of it is much of it could be used inside. We have a slew of clients who are just doing this, creating software inside their business as a system, a software system, for purposes of just being able to deliver their product better, faster, more efficiently, beating the competition in terms of their website, whatever it might be. The fact that they are working on software, and as many of you who are in the software or computer science business know that just because you've programmed something doesn't mean it works the way you intended. You have to go through a series of testing the program, make sure it doesn't have any bugs in it, and it takes a time. That process has a degree of uncertainty to it, as you can imagine, with the bugs that are going to get in there. And so therefore, those costs do qualify for this research and development expenditure. And here's some of the types of costs you can have. You can have salaries, supplies and materials, costs in obtaining a patent, if you're going for a patent, the lawyer's fees for that patent, and hiring outside contractors to help you with your research and development. Also, all these qualify, and there's more. I might want to say right this moment, parenthetically, that if you are, and I'll just for the heck of it, oops, that's not what I meant to do, so let's stop. I want to just see everybody for a second, or all the boxes. I might say parenthetically that if you're going to be doing something which will qualify for the research and development expenditure, you will need to hire a specialty firm to help walk you through getting the research and development tax benefits that we're now about to look at. I just want to mention that. So don't think you have to figure this all out on your own. You don't. Okay. All right, and away we go back to my screen. Some things that these expenses don't qualify under this category for the tax benefits we're going to see. We talked about advertising, that doesn't qualify. Assets that you have to buy in order to do your research and development, like you have to buy equipment like computers, that doesn't qualify. The research behind it, that doesn't qualify. And the actual cost of buying a patent, that doesn't qualify. So this is if you buy a patent from somebody, that's not going to qualify.
Can I ask a quick question?
Certainly.
So somebody submitted a question. These are R&D also tax credits, or do they go into income reduction?
So I've saved the best for last, and I apologize for that. The best for last is coming up, and that is what are the tax benefits, and we're about to get to those.
Thank you.
And so for that question, that person, I'll give him or her a prize because that was the best timed question I've had ever, because we're just about to segue to that point.
Fantastic.
We couldn't have practiced it any better. All right, so what were the pre-22 tax benefit rules? Let's find out what they are so we can understand better what's going on here in 2022. The most common tax benefit that you would get, this is not all, but this is the most common tax benefit that people would take with the research and development expenses, was the ability to deduct those expenses immediately in the year they were incurred. For startup businesses and businesses improving products in their startup years, you can imagine that most of the costs are going into development. Most of the costs are going into putting together the application that they're attempting to take to the market. And they have the ability to deduct that against income that they might have in the early years was a fantastic, immediately deducting the whole amount was a fantastic incentive for American companies to spend lots of dollars on research and development. This was a huge economic boon to the American economy. Another option was to write it off over 5 years. Most people didn't go for that. Another option, in case you didn't have any money coming in from that particular product, it was a 10-year period. We don't need to go there, because most people would take the deduction in the year that it happened. There's also a tax credit coming up, but let's go to what happened in 2022. In 2022, you can't deduct it immediately like you did. There's been a lot of uproar about this, that R&D activity has slowed down, that we need to have Congress re-up this intrusion in 2022 where you can't deduct it in full. What can you do in 2022? You can deduct it over 5 years if it's R&D done domestically. If you're spending the money overseas, it's a 15-year write-off. Obviously, they're trying to encourage the research and development to be done here, but they've curtailed the research and development costs incentive by saying you can't write it off in 1 year. So there is talk about Congress. It was in the last tax bill. It got kicked out at the last minute, but there's still congressmen, senators, and on both sides of the aisles, and congressmen in the House of Representatives that are looking at seriously trying to bring back the 100% deduction per year for the research and development. So stay tuned. It could be reinstated even for 2022. Now, there's still tax credits that are available for research and development. There is a tax credit in addition to the tax deduction incentive. The credit can be used by smaller startup businesses against Social Security payroll tax. These credits, by the way, there's very difficult to calculate. It's a fairly lengthy calculation, but they can range from 7 to 15% of the expenses that you have. I wish I could give you a more definitive way of determining what it'll be, but this is the range of what you'll wind up with. 7 to 15% of the R&D expenses that will yield your tax credit, depending on your circumstances. Now, usually you can use those tax credits to reduce tax, but a big thing for startup businesses is you can use it to reduce Social Security payroll tax for the employees that you have. That is big. Let me stop and say that again. That is big. This is a big incentive for startup companies that have huge payroll costs, which you probably will or could do, to get a write-off against the payroll tax that you have. And this payroll tax is Social Security, which is 6.2% of the salary. So it's a big incentive on startups that are not quite making a lot of income. So the tax credits don't mean much to them, but now they can use it against the payroll tax. So that's why the election is important, because you don't have to have a lot of income. You may not be paying any income tax, and maybe for some time you're not. So you get to use it against your salaries. As long as you have salaries, you're going to have payroll tax liabilities. So you can use those credits to reduce the cost of those salaries. An eligible business will have gross receipts of less than 5 million. So it's definitely geared to startup businesses, and be no more than 5 years past the period in which it had receipts. So a good way to look at it is if that's 1 year, 2 years, 3, 4, 5, and you're in year 6, and you do have some income, and these could all be 0, you're no more than 5 years past the startup period in year 6. In year 6, you have some income, you're definitely eligible for this credit. You could have been eligible earlier as well in the 5 years, but at the latest, this is how you would be able to use the credit. So you have to just do the circumstances. You have to apply the math. Good news is Congress raised this where you can use up to $500,000 of credits against your payroll tax liability currently. So you can see Congress is hugely incentivized to try to keep the R&D credits and the R&D expenses in the United States. I suspect that they will re-up the 100% deduction. Okay, unless any other questions, we're going to move on to other tax credits.
We do have another question. Isn't this 5-10 years amortization better for the startups as they won't have income in first or second year or so?
That could be, yes, that could be. But you have to remember that their investors oftentimes are investing, and the write-offs could reduce. Here's the answer to that question. The write-offs can reduce income into a negative zone. So we'll put that there. We'll say negative income. The investors can use that. You, as a entrepreneur, can't use that. You oftentimes have no other income, but your investors can use the losses passed through to them through a pass-through entity, and they may be very happy that you're losing money because of those expenses, and knowing that in the future you're going to make money. So while you're losing, the investors are gaining the benefit.
Thank you.
Okay. Work Opportunity Tax Credit, real quickly on this one, because we have a lot of other ground to cover. If you hire workers from several target groups, you can get a tax benefit. It's not huge, but it's not small either. Let's just see how it works. If the employees in a disadvantaged group, we'll see what they are in a second. If they're in this disadvantaged group, you may be able to get a $1,500 credit against your salary expenses per worker with no limit on how many workers you have. And that's if they only work 120 hours a year, which is really part-time. The limit is based on the fact that you can only take the first 6,000 of wages. If they work 400 hours, you can double it to 40%, and you wind up with 2,400 per worker as a credit against your taxes. And that's, again, the 400-hour rule, that if they work at least that much. And there's no limit on the number of employees that qualify for this. So you're now asking the $2,400 per employee question, which is who qualifies? And here's the list. And again, I'll give you like 15 seconds to peruse the list. While you're perusing, I do want to tell you from a personal story. I have 2 clients who have, interestingly enough, used this category. And these are people designated, all of these people are designated by the states that they live in. So you have to go to the state to get approval for who's eligible. But I've had 2 clients hire a lot of people from this category, and it's worked out really well. So there's sometimes people who are just made a mistake in life, and yet they're pretty intelligent or really intelligent and can be very helpful for your business. So I wouldn't discount any of the categories on this list. You can find some really good talent in there. Also, for the summertime, there's credits for if you hire people who could be interns, whether they're age 16 or 17. The whole thing isn't, all the Work Opportunity Tax Credit and for the 16 to 17-year-olds isn't automatically, you got to go to the state, you got to follow a strict certification process, and you'll probably need some assistance to do it. All right, I want to move on and make sure we don't miss some of the biggies. Qualified small business stock tax, not credit, but advantage. This is another biggie. This is as big as R&D. There is a lot of interest in this. Investors are really interested in this. And what it is it's the same idea as the R&D, same idea as all these credits, incentivizing investments in small business. And this could be you, where your business will attract investors in what's known as Section 1202, Code Section 1202, otherwise known as a qualified small business stock. What it means is if you're, let's say you got a great rich uncle and you want him to invest in your business, but he's like little, you do it to him and say, look, sell some of the stock that is tumbling right now before it tumbles too far. You'll have to pay tax on the gain. Well, maybe not. If you invest in my business, your tax will be, if you invest in my business, if you do it through a qualified small business stock, you may pay tax on the gains of stock you hold. But if you make money in my stock, you can avoid taxation altogether. So what it's doing is it's incentivizing people to invest. They won't avoid paying tax on the gains, but they'll avoid paying tax on the gain of your company's stock if it meets the qualifications. Let's just do that one more time. Basically, it's saying that if the stock of your business is held for 5 years by your investors and they make 100, or they make 1,000% profit, they may not have to pay any tax on that. There's some limitations, but the limitations are pretty sky high. Let's go through and see some more details. Just giving you the overview. People invest in your business. If they make a big profit, they may have little or no tax to pay, depending on how the numbers work out. So that's what we're looking at, reducing tax to potentially zero. First of all, the stock must be a C corporation. We learned what those entities were last week. So you will be restricted to having to be a C corporation with your investors. To qualify, the shares must be at original issue. In other words, you have to give out the shares as a C corporation. You can't be something else and give out the shares. You got to give out the shares as a C corporation. And the shares have to be held by the investor 5 years, which we've seen. The business's assets cannot exceed 50 million at the time that the shares are issued. That's what that means, at the time that the shares are issued. So if you're issuing shares and you're at 100 million, that won't qualify. This is really geared to startups, smaller businesses that are starting up. Many startups don't have $50 million in assets when they start. They'll have it afterwards. If someone invests 50 million, all of that will qualify. If that's the first investor and they put in 50 million, all that investor stock qualifies. The next million doesn't, but hey, 50 million qualifies. You have to be involved in a qualified active trader business, and this is where many of you might get slaughtered, sorry, but let's see what they are, and let's go to that list. Before we go there, I was going to, let's come back to this. Here's the exclusions. We'll come back to that slide in a second. Here's the exclusions. And unfortunately, some of you may see yourselves on here and be blocked out. Now, before you get the wrong idea, engineering is specifically people who do engineering as a profession, not engineering a product, not engineering a new design, a new application. So you might be doing engineering inside your business, but unless you're doing it as a profession, it's still, you can be doing engineering in your business. Consulting looks pretty bad, but it doesn't get considered to be an excluded service unless that's all you're doing. For example, you have an application that you're developing, and when you're selling it, you're consulting on how to use it, you're training, you're consulting on businesses that you're trying to sell it to, and on what you're going to develop for them. That's not consulting. Consulting is, again, like engineering as the exception. It's when you're doing it as the profession. You're not actually selling a product. You're only selling yourself, and only selling yourself. A couple other exclusions. You can probably see that this is on the list, so that doesn't qualify. There's still a lot of industries left that do qualify. Most likely what you're thinking of doing most likely qualifies. Let's just take a look at how much gain can be excluded. Remember the 5-year rule. The maximum amount of gain that can be excluded is $10 million or 10 times the adjusted basis of the stock. Let me give you a quick example to show you how powerful that could be. Suppose someone is investing you, the first dollars of investment are $50 million. The amount of gain, if they hold it for 5 years, that they can exclude on the sale of that stock after the 5 years is 10 times this number. It's the greater of 10 million or 10 times the initial investment. Hence, this is a really popular tax incentive to go into small businesses by investors, particularly startups, where you can get in before it's over 50 million. You got to get in before it's over 50 million in total assets. We have a couple other slides to go through, so unless there's any questions, I'm going to continue on.
I don't see any questions, but if anybody does, please feel free to submit them.
This is another area of interest to entrepreneurs, particularly starting entrepreneurs. It's called the carried interest loophole. It still exists. It's probably of importance to you as the developer of your product, the developer of your company, but it's also of interest to your investors. And here's how it works. Let's talk about what is carried interest. Instead of paying you, if you're the developer, instead of paying you compensation of the entire amount of value of your company's appreciation, we might pay you a set salary. You might set up a set salary. So this is for you, not necessarily for your investors at this point. This is for you. We might say to you, okay, we're investing in your company. We'll set up a set salary that you'll receive, and then you can get a bonus if you're deserving of that bonus. And let's say it's after 3 years, you can get a bonus, and it could be a huge bonus. If you perform a certain way and there's cash available, you could be looking at a huge bonus. Great. Now, even better is this bonus will be paid to you not as ordinary income, but as capital gain income. That's the carried interest. You'll receive it as a capital gain and you'll pay less taxes. So that's the bonus, not the compensation that's determined as you go along. It's the bonus that'll be treated as capital gains. And we can do similar for the investors. For the investors, we can pay them a low interest rate on their money, low interest rate, and give them a bonus if things are successful in the form of capital gain income. The difference, well, let's do it before we look at that slide. Oh, I unveiled the opinion slide. The difference is ordinary income rates, particularly for your investors, could be up to 37%. It's a sliding scale, but could be that high. Whereas capital gain tax rate, the highest it will be to your investors will be 23.8%. That spread is what your investors are interested in with this carried interest rule. It's important to you too, because your way of making a lot of money out of your business and paying a lot less tax, so you're interested in it as well. Now, Congress has been looking at this for every year for the past 10 years, because some think this is unfair. Some think that your bonus should be taxed as ordinary income. Why should it get special tax treatment? Well, it's because the law allows it today. So it may get outlawed. Congress may change the law, but it's still there today. And just to give you a typical investor scenario, about 80% of the carried interest carries to the limited partners, that's your investors, and 20% usually carries to you. So in a typical deal, you'll get 20% of the upside, your investors will get 80%. Each deal is different, each deal is separately negotiated. And that would be you, the general partner, receiving the other 20%. It will be called a fee, like a compensation bonus, but you'll pay capital gain tax and save the difference. All right, and I did say for 3 years, that's the only thing that they've tightened up. It used to be you could do this all in 1 year. Now you have to wait 3 years. For the carried interest to work now, you have to hold off from the time you invest, from the time you start, at least 3 years before you get that quote bonus. All right, timing wise, we're doing great. We may have extra time for some Q&A. We'll just run through some extra tax credits that are out there. There's a whole slew of them, but other tax credits that might be of interest to, depending on where you're holding. If you take an old building, even if you're not going to rent the old building, an historic building, even if you're not going to rent it out, if you're just going to use it for your development business or whatever you're doing, you're going to set it up for computers and people to do research there. I don't care what you do. If you rehab it, if you have that old building, you are eligible for a tax credit that is of interest. That will be of interest to investors because you can sell that credit to investors. So buying an old building to rehabilitate into your structure the way you want it to be can attract a great deal of money, basically because the credit is what the investors are looking for. You sell the credit to the investors and that money comes to you almost tax-free, almost interest-free, basically interest-free, not quite, but it's a great way to raise capital. If you're in this business, there are credits for doing this business in certain cities, certain states, certain locations. So if you're in this business, look to your locale where you're doing it for incentives to do it there. If you're doing a job training industry business, there are credits for that. There's credits for paying the health insurance of your employees. If you're a small employer or a startup business, you know that your employees are looking for you to pay the health insurance premium. And so there's a credit for that. Unfortunately, few of the clients that I've dealt with meet the requirement that the average full-time salary is less than $50,000 per year. The startups that I've been dealing with the past few years, for them to do their work, they're looking at $60,000, $70,000 at minimum to hire the kind of quality employees that they need to do the startup. So it's a tough one. Now, I'm not going to speak too much about it. I just want to let you know that if you've already started up and you started up after February 15th, 2020, and you're not aware of the recovery startup business, or particularly the employee retention tax credit, ERTC, if you're not aware of that, contact me. You can feel free to contact me immediately afterwards or in the next few days. I'll tell you a little bit more about it. And you can then get together with a consulting firm, experts who are involved in this and see if you're eligible for this. It's a huge tax credit. It's a pandemic related tax credit. I'm not going to say too much more about it, but if you were founded after February 2020, then you might want to find out if you're eligible for this, if you don't already know. Renewable energy. If you're in the industry of renewable energy, there are credits. If you're in the industry of solar, that's a huge area for credits. Also, even if you're not in the industry of solar, but if you have a building or a structure and you want to put up solar panels, you can buy those and you're eligible for tax credits. You can sell those credits to help you pay for the costs. Sell the credits, pay for the costs. Huge credits in solar today. Huge. Coal and gas industries are available for certain credits, also helps you get investment dollars. I want to just close and then take a little Q&A here, Ala. The state credit, all states also have credits. They call them angel investment tax credits. And it's interesting to note that Maryland has one of the premier angel credits like this, angel investor credits under what they call the Maryland Biotechnology Investment Tax Credit. When I say premier, states have looked at it, people have written about it. It was a really great piece of legislation that Maryland came up with. If you're in this industry, you would want to find out more about it. And here's a quick summary of it. I'll just read it with you. This biotechnology investment tax credit, that's what the BIITC stands for, provides an investor, again, what you're looking for in investors, with an income tax credit equal to 50% of the investment in a qualified Maryland biotechnological company. The program supports investment in seed and early stages of biotech companies. If this is close to your ideas of what you're going to be doing, get together with somebody in Maryland who understands it. If you're doing it in Maryland, it's been very successful. That's the other reason why it's been looked at by other states, because it's doing its job. And that is that. So we got some time for some Q&A.
Thank you so much. This has been a lot of very useful information, a lot to unpack. So we will post this video on our StartupUMD YouTube channel because I'm sure many of you will need to go back and review a lot of this information again to kind of make it sink in. But thank you so much for presenting it to us. We have a few minutes for Q&A, and first question is, if I have a technology startup and lose money in the first few years, can you deduct this loss against your other income, investment income from stock and bond rentals and etc.?
All you have to do is do that in what we call a pass-through entity business structure, which was last week's topic. That would be either partnership, limited liability companies, or S corporations. And the answer is, if you're involved and you're doing it yourself, absolutely yes, absolutely. If you're the one involved in the business. Now, if you're an investor, there may be some limitations to the investor on the ability to use those losses, but they still pass through. So yes.
And as far as I know, just to add to that, you can also spread it over several years.
Yes, once you bring it into your tax return, it will reduce your taxable income to zero. If you don't use all of it, you can use it in the future. There is some limitation on how much you can use in any 1 year. It's a pretty huge number, but if you go over that, again, it goes to the next year as it carries forward. It never dies until you die. Sorry about that part, but it never otherwise dies.
Yep, thank you. No, from personal experience. So the next question is, for R&D, does it matter if the income comes from sponsored research, corporate or federal grant?
I don't think so. That's a good question, but I would say no. It doesn't matter.
Yep. Yeah, like SBIRs or STTRs, all of that.
Absolutely, yeah.
Right. I don't see, actually, I don't see any other questions. If anybody would like, you can raise your hand at this point, virtual hand, and you can see the button either at the bottom or the top of your screen, and I can unmute your mic if you'd like. Let's see, we have a raised hand. Laura Newman. Let's see. Go ahead, Laura.
Maybe she has her mic muted. Let's see. Yeah, she's muted. She has to unmute. That's all. Or maybe you have to unmute her.
No. Laura, you are allowed to speak if you can unmute your mic and ask your question that way. And so just to add, Laura Newman is our entrepreneur in residence, is a very experienced technology entrepreneur.
Oh boy, good.
While we're waiting for Laura, here's a question from Jeremy. Can we contact you with questions in the future, or do you have consultations?
You can contact me through my email address at the school. The way this will work is that I will do it without solicitation for new clients. I will do it as my job here at the school, help you as much as I can, until such time that we both agree that it's reached the point of it should be a paying job. And then I'll give you referrals of other accounting firms or consultants, experts in the particular area that you're in. So I don't do this to drum up business. This is purely my giving back to the school.
Yes, thank you. You can sign up for an accounting degree with the University of Maryland and take Sam's classes.
There you go. That's a good one. I like that.
Yep. So Laura's telling me that she can't, for some reason, unmute her mic, but her question is there a good resource that's easy to read for an overview on the tax issue?
Oh, for startups, it's interesting. You know what I can do is you and I will work after today. I'll see if I can put something together, either reference material, or maybe I'll even just cull a lot of the sites that I use in research preparing for this and put it into some type of form. That's a great idea, Laura. Yeah, some type. It's very complex to do, I would add, Laura, because I don't know if I may be exaggerating, but there's like 1,000 credits out there, 1,000 types of incentives that would apply for existing businesses, and all types of those credits and incentives apply for startups as well, as you can imagine. But I'll see what I can do. That's a great challenge. Don't hesitate, Al, to knock on my email box a couple of times. Let's see if I can do something in the next week or two.
Yeah, thank you so much, and we'll definitely invite you back for another session in the future, whenever you have time for us.
My pleasure. My pleasure.
Thank you. Let's see, we have, yeah, that was the question. All right, I don't think we have any more questions. And if you do think of one, please send them to me. I'll forward them to Sam, and please. So I posted in our chat the link to the previous session, last week's session. So if you'd like to go and watch that one, and I will post today's video on our StartupUMD YouTube channel as well, so you can review the materials.
And if it's okay, I'll make a couple closing remarks.
Sure.
Okay. In closing, hopefully you saw that there's a lot out there. It's complex. Each credit, each particular tax benefit or incentive has a lot of myriads of rules. These are things that you will need experts and consultants to work with, both tax accountants, tax lawyers, perhaps others, like for example, solar. There are specialists out there that's what they do for a living. They help you get your solar credit. There are specialists out there for that employer retention tax credit that I mentioned if you're a startup after February 2020 during the pandemic. And don't hesitate to talk to me about who you're thinking of using if you want some advice or some help in making the decisions. But anytime you're getting into a startup business, you're going to need help in raising the investment capital and in structuring it in your business in such a way that protects you. This is outside the scope of my presentation, but angel money, investment money, private equity money should not be handled by you alone. You need a good lawyer and a good consultant by your side. I've seen too many people who did it on their own, and the results were, let's say, horrific at worst. So, and I wish you luck. That's my last closing remark. I wish you the best of luck in whatever endeavor you do. And please feel free to share your successes with us in the future.
Thank you so much, Sam, for sharing your time with us. So as a reminder, all of our speakers are volunteers. They're not paid. They're here because they want to help. So thank you so much, Sam, for your time and expertise. And we'll definitely would love to have you back to talk on additional topics in the future.
Yep. What Allah pays me is zero, and I'm starving at the moment.
Thank you.
Thank you.